Crypto can make you rich, but it can also wipe you out overnight if you're not careful. The world of cryptocurrency trading is fast, exciting, and full of opportunity, but it's also extremely volatile. One bad move or emotional decision can lead to massive losses. That's why today, we're talking about the most important skill every crypto trader needs to master: risk management. Risk management isn't about avoiding trading. It's about protecting your capital so you can trade smarter, longer, and with more confidence. Whether you're a beginner or have been trading for a while, learning how to manage your risk properly is what separates winners from losers. In this video, I'll break down simple yet powerful strategies that can help you avoid common mistakes and protect your money in any market. Let's get started. Why risk management matters. The crypto market is known for its massive potential, but also for its extreme volatility. Prices can swing up or down within minutes, and a coin that looks promising can suddenly crash without warning. This fast-paced nature is what attracts many people to crypto, but it's also what makes it risky. Even if you've done your research and picked a strong project, things can still go wrong. A sudden tweet, news announcement, or market panic can flip a good trade into a big loss. That's why having a risk management plan is essential. It's your safety net in an unpredictable environment. Risk management isn't just about avoiding losses, it's about protecting your capital so you can keep trading, learning, and improving. Think of your capital as your fuel. Without it, your trading journey ends. But with proper risk control, even if you take a few losses, you still have the power to recover and grow. In short, risk management is what keeps you in the game. It's not about being right all the time. It's about surviving the bad trades and thriving in the good ones. Master this, and you'll already be ahead of most traders out there. Top risk management strategies. Let's dive into the most effective strategies to manage risk and protect your money while trading crypto. These tips may sound simple, but they are powerful if applied consistently. 1. Never invest more than you can afford to lose. This is the golden rule of crypto trading. The market is unpredictable, so never use money meant for rent, bills, or emergencies. Only trade with funds you can afford to lose. This mindset helps you stay calm and avoid emotional decisions. Second set. Stop loss. Orders. A stop loss is a tool that automatically sells your crypto if the price drops to a certain level. It protects you from massive losses if the market moves against you. For example, if you buy Bitcoin at $30,000 and set a stop loss at $28,000, your position will close if the price hits that point, limiting your loss. Third position. Sizing. Smart traders only risk a small part of their portfolio per trade, usually 1 to 2%. This means even if the trade goes wrong, you still have enough capital to recover. Never go all in on one trade. It's tempting, but extremely risky. 4. Diversify your portfolio. Don't put all your money in one coin or project. Spread your investments across different assets. That way, if one coin drops, others might hold or even grow, balancing your portfolio. Diversification helps reduce overall risk. 5. Avoid emotional trading. Fear and greed are the biggest enemies in trading. Don't let emotions or social media hype control your decisions. Stick to your strategy, use data, and stay disciplined. Avoid chasing pumps or panic selling during dips. Tools to help manage. Risk management becomes much easier when you use the right tools. Most modern trading platforms offer built-in features to help you trade safely and smartly. 1. Trading platforms with risk control. Platforms like Binance, Bybit, Qcoin, and others come with helpful tools such as stop loss and take profit orders, margin settings, and portfolio analytics. These features allow you to set limits on how much you're willing to risk per trade, so you don't have to monitor the market 24/7. 2. Use risk-reward ratios. Before entering any trade, calculate your risk-to-reward ratio. A good rule of thumb is aiming for a 1 to 2 or 1 to 3 ratio, meaning for every $1 you risk, you're targeting $2 or $3 in profit. This helps you filter out low-quality trades and stay focused on opportunities that are truly worth it. Third, track your trades and learn from losses. Keep a trading journal or use apps that log your trades automatically. Record why you entered a trade, your targets, results, and what you learned. Reviewing your wins and losses helps you identify patterns, correct mistakes, and improve over time. Conclusion and final tips. Smart trading is safe trading. Always remember, protecting your capital is more important than chasing quick profits. Have a clear plan before entering any trade and stick to it no matter what the market throws at you. If you found this helpful, drop a comment and subscribe for more crypto trading tips and strategies.